Hi everyone, this is Ron William, dialing in from MIG Bank based in Switzerland and back by popular demand, quite literally. Thank you everyone that requested a part 2 session to this webinar on key lessons from past FX trends in 2011 this year, and most importantly, trade opportunities into 2012. Now I'll quickly let you know in a few moments what the key points today are going to be. But before I go into that, again, just the house rules in terms of contact details if you would like to follow up with me. My email address is r.william@migbank.com, and you can feel free to send me an email on that email address. Also, MIG Bank are set up on various social media forums, but I also specifically have an account on Twitter if you just type in rwilliam77, and on LinkedIn if you just type in my first and last name. And then right at the bottom there on forexstreet.net, the FX Street blog forum, I update ad hoc key market topics, so feel free to kind of follow my ideas on there, or again to ask questions. Okay. And just a little overview for maybe some newcomers today. I've been in the market for well over 10 years and working here at MIG Bank now for a year within the research team as a technical strategist. But before then, I worked at various other institutions. More recently, before here, I worked at Bloomberg, the financial media company, as a technical strategist, basically visiting institutions and clients around the world to try and help them improve their trading strategies, but also, of course, to develop certain new ways of looking at the market. Now, throughout that time, there are 3 areas that I focused on quite keenly, and they are exactly what is on the screen at the moment. First is market cycles, and that's just basically timing, being able to identify key moments in the future when price moves are likely to take place. But that's also looking at correlations in the market. So let's say between one asset class and another, let's say commodities versus the FX market, for example. Second is chart pattern setups, specifically Japanese candlestick setups, which is something I specialized in pretty much from day one. And that allows you to gain an edge in terms of finding basic psychology in the market, but also key turning points in the market. Most candlestick pattern signals are reversal signals, and so by their very nature, they do help in volatile markets where price swings tend to be developed most. Last but not least, on the more advanced side is indicators such as DeMark indicators developed by a very well-known, well-respected investor trader called Tom DeMark, whom I was very fortunate enough to work with while I was at Bloomberg. I use his indicators, which are primarily counter trend or contrary indicators, and very good market timing indicators. In addition to that, I have my own proprietary strategies, which I overlay on all of this. These are the 3 core areas that I focused on for many years. Of course, there are many other things that I look at, but these are the 3 key points that at least maybe allow you to understand where my perspectives are coming from on this presentation and in future webinars that I present. Now, I traditionally ask this question, and I'm pretty sure we have a mixed crowd today. These MIG Bank webinars in association with FX Street are gaining popularity each month. We've been holding them every month for almost a year now, ending off the year with this part 2 webinar. And my question to everyone here is, where in the world are you attending this webinar from? And if you could just let me know, is this the first time or that you've attended my webinar, or are you a repeat attendee? So where in the world are you from, and is this the first time or not that you've attended this webinar? So if everyone could just contribute to this, it's a great way to kind of break the ice between each other. And I'll just quickly read the list. Florida, North Korea, UK, rainy London. Big fan of your webinars. Thank you very much. Brazil, first time. Welcome from Brazil. Austria, first time. UK, another UK person, England, Philippines, Canada, China, Singapore, and a repeat from Singapore, Norway, UK, Kent, North Korea, Japan, attended before, Ontario, Africa, UK. We have such a big mix there. I'm quite impressed and honored by everyone's attendance. New York, and I'll let that list continue. But first of all, I want to make the point that I usually make, that it's wonderful to have such a great contribution from across the world. It's truly a global world, financial world that we live in. But one of the key points I want to make here is it's a great reflection of money, capital flows, moving from one country to another country all the time. We are all connected. And no country, no person is in isolation. Everything that happens in the States impacts Asia. Everything that happens in Asia impacts Europe. We're all very much part of an interconnected web of financial market consequence. So just keep that in mind in terms of everyone's going to have a different perspective on what we talk about now, but also a different perspective of what happens in the market, because you all have your own financial interests at hand from so many different countries. But the one language we all share in common is capital flows and, of course, market interest. And just one last person, no rotation at all, located in Frankfurt, Germany. That's very good to have you here as well. Welcome from Germany. Okay, so my point is it's wonderful to have so many people from so many different countries. It's wonderful to have a growing attendee group, as people that have attended time and time again. Thank you very much. Really appreciate your support and your questions. But also the newcomers, really welcome your attendance. I hope you enjoy this webinar and future ones to come. And please keep in mind, we are all here because of market opportunities, and what makes this great is from so many different parts of the world, we get to share ideas and ask questions and basically ask ourselves the question, what is the next opportunity in the market? So please feel free to ask questions throughout this webinar. Now, the point I want to make to people that maybe are attending this for the first time is this is a part 2 webinar. The part 1 webinar happened about last week. You can watch that recording. Please just check the FX Street website. A link will be put probably at the end of this webinar. Having said that, I do still need to go over some of the points that was mentioned in the last webinar just to refresh the memories of some of you here that saw it before, but also to give a foundation base for some of you that maybe hadn't seen that material. Once I've just done a quick review, I do want to then, of course, focus on, so that's part 1. Once we've finished part 1, I do want to focus on part 2, which is more time on trade opportunities in 2012. If there are markets that I don't cover, I'm only going to cover a few markets, please feel free to ask questions, because I'm going to leave some space for people to ask questions about markets that are important to you. I know that from a lot of emails that I've received from people from this webinar and previous ones, that everyone is obviously checking their portfolios at the end of the year, and they all want to kind of position themselves successfully ahead of next year. So if there are individual markets you'd like to ask me about, please note it down right now. And in the middle, part 2, please ask me which markets are most important to you. And I'll give you just a general observation. Part 3, hopefully, I'll make time for, because this is the section which we missed out last time. This is just a very quick section on volatility and how to successfully manage volatility in your trade analysis. This is a short section because it's a preview to the larger session, which we'll see in mid-January, which is just going to be focusing purely on volatility and how to trade successfully during those markets. Okay, is that clear to everyone? So part 1 is just a quick review of some of the key areas that we covered last time. Then we'll be looking at trade opportunities in 2012. I want to include a few markets that you want to actually look at. So I want to keep that open. And yes, to that question, in terms of the last section, period analysis is just basically a classic way that I look at the markets, and it's a metaphor for how I actually look at the markets. It's 3 key stages which are shaped within a pyramid. the top part of that pyramid being the most important, and it's kind of like a workflow of my analysis, basically. I hope that helps. But hopefully we should have enough time to get to that stage. I'll just quickly shoot through. Okay. So just a quick disclaimer, no information published constitutes solicitation or offer to buy or sell. This is just educational, informational purposes only, and it's just a disclaimer I just have to show for legal reasons. Okay, now in the very last webinar, it was a focus on the best and worst performance of the year. And I asked everyone the question, out of this list of FX currencies, FX majors, commodity FX, but also frontier or otherwise known as emerging markets, which one of these currencies, which set of these currencies has performed the best and which ones have performed the worst in 2012. And this is just basically a measure of percentage performance based on the spot value of that FX currency. So I'm just going to quickly ask this question and then quickly move forward through the other slides. For those of you that might remember, or for those of you that are being asked this question for the first time, which currencies do you think performed the best? Which ones do you think performed the worst throughout the year of 2011, this year? If I could just get a quick show of answers. Which currencies do you think performed the best and worst this year? So just feel free to type in the currency into the chat. I'll just wait a moment or two. Any ideas? So anyone think? So some people saying Aussie or Norway, so Australia or Norway, Japan the best, dollar the best, yen likely to be surprised. Another person saying yen. So we're getting a few people saying yen. Which pair is the best trend or range? Good question. Swiss franc the best, euro the worst. There's a nice mixture of suggestions or views here. Newbies can maybe go to part one and see this again. But just going very quickly, everyone had a different idea. Usually people choose the Swiss franc or euro or the more kind of psychological political currencies. But just for focus, the top five, Japanese yen and some of the emerging markets, and the bottom five, the worst performing, again, another emerging markets. But the key point here is that actual performance, whatever the currency in 2012, was actually quite poor. You can see there that the performance, the positive performance, was a maximum of 4 and a bit %, and the maximum underperformance was equal to about 18 or so %. So there was a lot of negative underperformance in this year, and the best case scenario was actually quite poor. I'll quickly go through the slides just for the concept of time and focus on this slide because this is quite a key slide here. This is focusing on my views for 2012, and it's important to everyone just to kind of remember what my view is now and into 2012. This is the change in cycles, which I believe is likely to increase volatility, or already has created volatility in the second half of this year, and most probably increase volatility even more than what we are actually experiencing for the first half of 2012, if not longer. Now, these are basically 3 cycles that you can see on the screen. The big fat blue line is a long-term cycle. Think of many, many years. The turquoise zigzag line is medium term, and the short term is the red dotted line. Now, just a quick recap. I believe that the current economic situation in Western markets is roughly where this arrow is pointing. And just so you can get an idea of before and after, I believe that 2007, the financial crisis crash, is basically at the top of this entire macro cycle that I'm showing you. 2009, that was the big price fall that we had between 2007 and 2009, the big capitulation. During that time, Lehman Brothers collapsed and various other institutions came under pressure. But since 2009 into the first half of 2011, we've had a very strong recovery period, which most people in the market believed and maybe hoped to some extent would be back to good times, back to the pre-2007 growth times within Western markets and just across the world. Now, of course, most people are realizing that might not be the case. Any time we have a big financial crisis, it is likely to take substantial time for the market to recover, many years in my opinion. And so for that reason, I'm labeling 2012 at the bottom of that potential decline. So basically between the first half of this year and certainly into next year, I believe that we're going to have the next down wave move in the economic side of things in Western markets, potentially globally if that starts to affect Asia. And of course, we will start to see this across the board in most of the markets. Any questions on this point? I just want to just stop for a moment. Anyone have any questions on this? Because this is my roadmap, and I'm hoping that once you actually really kind of crystallize this roadmap in your minds, it'll make it so much easier to understand everything else that I show you. Any questions here? Is that clear to everyone? Just to check. Just say yes if it's clear, just so I know to move on. Everyone okay with that? Okay, great. Okay, so basically, very simply, economic markets at the moment, just what I showed you, we basically had a great recovery period. Keep in mind that the top of that's 2007. 2009 was the end of the decline from 2007, had a recovery into 2011, and probably a price fall down. And yes, this can be shown in real-time charts. Probably in future webinars on cycles, I'll do that. Now, the real-time chart, to answer your question, someone's just asked, how can you see the real-time chart? This is the US GDP chart, which I showed in the last webinar, but I'll show it again because it's so important. This is basically showing you US GDP, so gross domestic product on a quarterly basis. And anytime this line moves below the 0% line, the horizontal red line that you see there, on 2 consecutive bases, that symbolizes an economic recession. 2 consecutive negative periods of GDP is a recession, as the economists term it. And you can see there in the red circles previous recessions that have taken place. This is a chart of US GDP going back to the 1970s. And the most important recessionary period I want you to focus on is the 1980s double dip recession for 2 reasons. One, the recession had a very started initially with a very low base. So growth in the States actually dropped to well beneath -5%. And for that potential reason, we had a double dip. Anytime you get a very low base move where a recovery begins from, it tends to create an unsustainable growth cycle, which then turns back lower and mean reverts below the 0 line, i.e. Negative growth, and then into a double dip scenario. Now this is a similar price pattern, maybe different economic story, of course. Things are probably worse, much more now from an economic standpoint. But we can see here that in 2009, when we had the major low from that big capitulation from the 2007 financial crisis, which I showed you on the theoretical cycle diagram before, you can see we had that major recovery period, and it is, as we are speaking, pushing towards the 0% line or negative growth. So a lot of economists, a lot of kind of well-respected, well-known economists have been calling for strong growth into next year and the year after. In my opinion, are going to be proven wrong in a big way, not because their analysis is not successful or not strong enough, but just purely these are irrational times. These are new times that we probably haven't experienced in such a long time. So most of the views that we've had for the last 20 years might not apply as well as they did in the past right now, right here, right now. So keep in mind that we are in a new normal, to quote that famous quote. And I believe, of course, that if you look at this GDP chart from the US, that it symbolizes 2012 might actually be the start of this double dip recession scenario. Now, once you keep that in mind, negative growth in the States, but also negative growth in Europe. Keep in mind, this isn't just US, this is also a similar picture for Europe. Then you can start to think in terms of, the major global consumption out there, with exception to Asia for the moment, that's a different story, will start to hit the big markets. And so obviously the big markets that will be hit by consumption, you can look back to commodity markets such as copper, oil, and probably silver. Copper is a very important industrial metal, and of course if there's a big decline in copper, that generally symbolizes contraction in the economic growth. Similar situation for oil, which is currently falling. I've updated this chart. Remember last time we spoke, I was saying that oil's previous rise was under pressure into the $100 mark. We have now sold off very sharply from that $100 psychological level, which is also a key Fibonacci ratio, the 61.8% golden ratio. And we're very close to hitting that $90 mark, and what I believe further beneath that, $83, which is the pre-crisis that was in Libya and most of the Middle East. So oil, copper, silver, all these three key economic commodity markets are likely to fall much more over the next few months. That's basically my view, and that's mainly driven by the fact that economic growth is starting to really weaken and potentially turn negative over the next few months. I just want to make that clear. And this is how you can interconnect inter-market relationships, the correlations in different markets. If you start with the big picture first and then drill down, it is, in my opinion, a much easier and more successful way of actually understanding what is happening in the world around us. Now, I'm going to quickly fast forward through here. Just a quick point I'll make here is that basically this year has been two halves. It's been a game of two halves. The first half was risk appetite continuing from 2010 and 2009. Remember that chart I showed you on the cycle chart and on the GDP chart. We've had a recovery period since 2009 into the first half of 2011, but the second half of 2011 has been an unwinding of risk. Now, people have been talking about risk on, risk off, like it's some kind of intraday binary trade, and I really think this is pointless. We really need to kind of regain our perspective, and in my opinion, look at our long-term charts more often, because they're really useful in providing the perspective at critically uncertain times, which we are currently in. We are in very uncertain times, and the best way to get perspective is to switch off that intraday chart just for a moment and start looking at your multi-year charts and just look at where the big moves have come from, what extremes might exist on that chart, and what themes are starting to unfold as we speak, because that will allow you to get ahead of the game while all the news comes out, positive, negative. We had this story out of North Korea today, which is unfortunate and in market terms potentially negative for risk aversion. Is it? Did much happen in the market today in reaction to that? Keep in mind that you really need to be looking at your long-term charts, and you really need to be asking yourself the question, what is the next big move that's likely to happen? And that is really where I spend most of my time. I do focus on intraday for my timing purposes in terms of entry and exit levels, but big picture really does give me that perspective. So first half of this year has been an extending of risk appetite from 2009 and 10, but the second half of this year, and very much in the last few months, has been an unwinding of risk. And so any market which is correlated to risk appetite is starting to turn lower, and commodities is one of those markets. Now, the key signal for me was October 31st. That's actually when the Bank of Japan intervened with roughly 7 trillion yen, one of the largest interventions they made since late last year. That intervention, coupled with the bailout fund success story, when political leaders basically announced that there would be an increased bailout fund for the peripheral countries in Europe, that created a massive positive acceleration to the upside, where we saw key risk appetite markets like the S&P 500 and Eurodollar push above their long-term 200 moving averages. And of course, these are levels that everyone in the market look at on a regular basis. Now, what happened shortly afterwards, that basically people bought in the rumor, sold in the fact, and they sold even more when you had the Bank of Japan intervene on the Japanese yen to try and unwind the record strength on the yen, which of course was harming their competitive export-led economy. The key signal is that ever since October 31st, we've had a massive reversal in risk appetite. And the S&P 500 and Eurodollar are examples of that. If you just overlay the 200 moving average, you can see that. And the key for me is the psychology that happened at that time. The fact that these markets turned violently after very good news tells you something about the positions in the market that would have got squeezed there and then. And anytime you get a trade position squeeze in the market, it sets up a beautiful trade setup on the other side of the market direction. Now, further evidence of that is this new volatility cycle, which I believe is going to continue into 2012. This is a picture of the volatility indices based on the S&P and the Euro stocks. And you can see here that we are still developing a volatility cycle which can easily push higher. Now I'm going to show you a level here. If you look at the axes on the right-hand side and just look at the 80 level, that is very easily how high we could head up on these volatility indices. And what that means is you'll get sharp sell-offs on most of the risk markets that we know and love, like Eurodollar, the S&P, Australian dollar, maybe commodities, gold, silver. Keep in mind that gold and silver, of course, traditionally, specifically silver, tend to move up during risky times, during uncertain political and economic times, but this may be the exception in time. I'll talk more about gold. This is a key market call of mine. Please feel free to ask me questions about gold when I get there. But the key point here is new volatility cycle into 2012, which follows an unwinding of risk and, of course, an increase in volatility to come. One important chart is the silver-gold ratio overlaid the S&P. I'm not going to go into this too much. I've explained this in the previous webinar, but just keep in mind this is a very interesting chart to look at. The silver-gold ratio tends to lead and predict ahead of time major turns in the equity market. And so we see here in the first instance in 2008, during the financial crisis, the silver-gold ratio turned very sharply and violently before the equity market did. We are seeing a similar signal right now. The market actually turned much earlier in spring of 2011 when silver capitulated to the downside from that $50 historic level last seen in 1980. And it is currently about to make new lows. You see that red line just about to punch to a new low, basically anchoring down equity price moves in the coming weeks and months. I do not expect a Santa Claus rally as is traditionally looked for at the end of the year. I believe that we are going to see many exceptions to the rule over the next few weeks and months. And this ties in with a lot of my cycle analysis, which I'm not showing here, but I'm just trying to give you just a quick big picture. Now this is an update of USDJPY big picture 2-year trend. And as the moment it did that, it's been bearish since then. The retest of that 2-year trend and then the failure at that 2-year trend is the key trade setup that I've traded for many years. It's basically a failed signal which works beautifully on the other side of the trade. Remember I told you that reversal from the 200 moving average on Eurodollar and on the S&P and various other markets was a very good psychological squeeze in the market. But this chart is telling you exactly why. Eurodollar reversed from a 2-year trend, and what I call that basically the kiss of death. Whenever you have a key structural level holding that market for a long time, then the market breaks beneath it and retests it and fails, That then produces a wonderful resumption on the other side. And of course, the key levels I'm looking for, 130 we've already seen, so we're likely to actually hold around that 130 for a short while people try and cover their trades. I heard in the last webinar someone talking about trade positions in Eurodollar at record lows. I look at trade positions on a regular basis, CFTC trade positions out of the States, and it is a great way to look at the flip side of the trades in the market and to see the psychology behind the market. But keep in mind, it is a lagging indicator, and you need to interpret it in many ways in order to trade it successfully. Right now, I would say that record short positions on Eurodollar is a sign that the market would like to unwind, but I don't believe that unwind is going to last much longer. I think maybe we see a move up to 132, 133, even 135, and we're still going to see a retest of the 2011 major low at 128.70, and of course much lower than that. Similar to the previous presenter, I won't go into my bigger Eurodollar forecast because I'll be giving another interview in next week, this Friday. Basically, I'll be on Bloomberg in London on Friday morning, early morning for those of you early birds. And very recently, I was on CNBC Squawk Box just last week, talking about the Japanese yen, which I'll talk about in a moment. The key message on Eurodollar: reversal from 2-year trend, broke beneath that structural level, retested it, and then fell back down again. I believe this is definitely more than likely going to hit the 130 level on a sustained basis, and then 128.70 and much lower into next year. Someone's asking the question, too bearish, don't forget Fed is powerful. Fed can start QE3 with trillion 2012 to kick off the market. Possibly. I do obviously have key levels that would negate this view. Above 135, we'll put this view on hold. But there are many reasons why I think that even QE3 will not impact the market as it did before. The market is considerably fatigued by central banks trying to fix everything, meetings in Europe, regular meetings with no outcomes, and so people are tired, and people are losing money on confidence trades with these economic political leaders. And for that reason, the market at the end of the day is going to trade the way it believes the money will move. And right now the money seems to be moving out of the States, seems to be moving out of Europe. But if you look at those two regions relative to each other, Europe seems to be worse than US for now. Now that risk will rotate from region to region, and I mentioned that in the last webinar, but for now I believe it's more euro negative than it is US dollar. And as one person said, potential head and shoulders. I'm not a big fan of kind of very long-term chart patterns, especially the head and shoulders, because that can be quite messy at the best of times. But yeah, there are very long-term reasons why Eurodollar is likely to push much lower than it is at the moment. CDS chart is a reason, of course, why things are getting worse in Europe, with Greek CDS rising by 5,000 basis points a short while ago. This contagion is likely to hit Italy, Spain, Portugal. The orange line is the flat line. Basically, it looks flat because Greece is looking crazy at the moment in terms of risk, default risk. But without that Greek question mark, all the other peripheral countries are likely to be impacted much more. Now I'm just going to fast forward to the key markets. Gold, I've received a lot of emails recently, emails asking me about gold, but also, if I may say humbly, emails congratulating about my long-held gold view, bearish view. And the key point about gold is that, I mean, gold is continuing its decline from that 1921 level, but most importantly, gold has broken beneath its long-term 200-day moving average for the first time in 3 years. I've given a webinar on gold before. I've written a special report on gold. If you want to receive that report, please just send me an email. I'm more than happy to send it to you. I've gone on the record on media, television media, but also on various other publications, saying that if gold breaks on a sustainable basis beneath 1530, we are likely to see a move into 1300 and worst case scenario, I highlight the word worst case scenario, 1040, 1000. Now someone's saying Barclays Capital forecasting $2,000 for gold in 2012. That is possible. One key point that I want to make here is I'm not a gold bear. Short term to medium term, I am bearish on gold, and I believe that gold, if it confirms beneath 1530, which is basically the price swing low that you see there, then we see a move down to 1300 and potentially 1040, 1000. This creates a very unique buying opportunity into 2012, depending on what actually happens on the chart in those months. But keep in mind one thing: the last time that gold actually hit a key level like $2,000 was in 2008 during the financial crisis. The one time in history when gold fell during a big economic and political crisis period. It not only fell by 34% from that $1,000 mark, it moved sideways in a very volatile fashion for just under 8 months. I believe that we're going to see a similar scenario to the year 2008. I don't have the chart here with me, but please, for all of you who are interested in gold, look at 2008 on gold, and you will see that it hit that $1,000 mark, could have shot through the sky above $1,000 during that financial crisis period. It didn't. It moved sideways in a very volatile fashion, down 34%, and moved sideways for 8 months. Key reason, deleveraging. People needed to unwind their trades to pay for the bill, and that is what is likely to happen now as we see further turmoil extend from the financial crisis. I don't mean to sound bearish, but I'm just being very practical in terms of what the charts are telling me at the moment. If those charts change in terms of price levels, then of course I will keep you informed. But as it stands now, things are likely to get more bearish before they get better. So someone's asking, general rule of thumb, do exact opposite of what Goldman and Barclays analysts say is a good way to trade with momentum. No comment. What do you trade? So could you expand on that question? What do you trade? You mean during these times? If you could just expand on that point, and then I'll move on to the next chart. Keep in mind that gold is one of the big safe havens, and for now it is more of a risk trade than a safe haven trade. Swiss franc, same thing. Another safe haven trade turned to a risk trade ever since the Swiss National Bank intervened and pushed the market up by 30%. They didn't push the market up by 30%, but as a result, the market moved up by 30%. So whichever way you look at it, the Swiss franc now has decreased a substantial amount of safe haven flows out of one of the most infamous safe havens. And the third safe haven, Japanese yen, I believe is going to be one of the biggest trades. Borki's asking me what are the big trades to come in this volatile market environment that we're going to probably experience in 2012. I believe that Japanese yen is probably going to be one of the biggest trade setups in 2012. One of the biggest trade setups. Having said that, it still continues to be very painful and volatile, two-way volatility. So I would really encourage you to be as cautious as possible when working out entry and exit levels on either dollar yen or euro yen and any other Japanese yen derivative. We are likely to see a major reversal. I've gone on the record and said that Japanese yen is going to verge on a 40-year cycle reversal. So I believe this is a really big, significant reversal that we're going to see. And if you just look at your weekly multi-year chart, you can see a multi-year pattern which is anticipating breakout above that 80 psychological level and thereafter 85. But the point is we're going to get a big weakening of the Japanese yen, which will help the Ministry of Finance in Japan with their mandate. And we're going to see a big change in mass psychology. So all the reasons for Japanese yen appreciation, safe haven flows, and carry trade, where people have been using the Japanese yen as a funding currency for actually investing in higher yield markets, is going to change. I believe that that change is probably going to move into the US dollar. So if you want to ask me what are the biggest trades over the now and into the next few months, I believe it is Japanese yen weakness broad weakness across many currencies, especially the emerging market currencies, and US dollar strength, and potentially a few short positions on the euro dollar as a consequence, some of the commodity markets, copper, gold, silver, oil, and so on. These are the key ideas that I'm focusing on. Massive unwinding of risk. The safe haven plays that you've been looking at before have changed. Keep in mind it's a domino effect. The world is running out of safe havens for now. Gold is not a safe haven market as it used to be. Swiss franc is not a safe haven market as it used to be. And the Japanese yen is soon going to surprise us all with a massive reversal, probably in the next few months. I predicted that it would happen in early December, but I was a bit too early on that. What I was correct about is that the first 2 weeks of December were going to be very volatile weeks based on my short-term cycle analysis, and that was proved correct. So for now, just probably some quiet markets, but I believe certainly January, February, early next year, we start to see volatility pick up again. Now, a question I'm being asked about dollar yen may change to parallel channel, can't it? I don't want to get lost in various kind of technicalities of the pattern. What I can say is that my view is that we might likely see a new record high on Japanese yen, record low on dollar yen, beneath 75.35 before we see this massive reversal to the upside. There are many reasons why I believe that. If you want more details on that, please just email me and I'll send you the comprehensive special report on dollar yen. That's much easier. And also I did a webinar on it on FX Street, so you can have the best of both worlds, that special report and the webinar. Now I just want to fast forward to the part 3 section on volatility. This is just a new chart on US dollar. Keep in mind the US dollar has now pushed up to a new 11th month high. For all of the people in this chat that are still bearish on US dollar, think twice. The market is up over 10% from its historic lows. It is now at 11-month highs, and this is one of the very few markets which is actually moving up while everything else is moving down. And one of the key reasons for this is deflation and deleveraging. A lot of people around the world, specifically in the Western markets, are starting to downsize their portfolios. Assets are starting to deflate, and this is at least my view from an economic perspective. And so for that reason, we are starting to see US dollar gain. My email address is r.william@migbank.com. r.william@migbank.com. I'll show it to you at the end of the webinar. In terms of your question about dollar yen hitting 72, it all depends what happens over the next few weeks. I think that we will likely, it'll be a two-stage trade setup where we break beneath, potentially first make a new record low beneath 75.30, the post-World War II record low, into potentially 73.50. That's my downside target. I'm not too keen on the 72 mark. Anything's possible, but I do believe it'll be a very short, dramatic price spike where a lot of positions will get stopped out, and then before we get the reversal. And I'm quickly going to go through the review because we have to finish up in a few minutes. Part 3, this is just a preview of what you should expect in the webinar in January that I encourage you to sign up for. Volatility, how successful can you manage volatility, pyramid analysis, and new trading guideline. I'll go through this very quickly. Just have 5 minutes just to go through this. I don't want to spend too much time on this because this is a preview of what to expect in January. Keep in mind that this is just a probability curve volatility and just showing you that volatility is what we're experiencing at the moment. My pyramid analysis model is just very simple. It's just a quick and easy way of doing top-down analysis. Start with the macro, then drill down to the micro. Trend analysis, including cycles, key levels, indicators. This is the workflow I'll go into within my next webinar. Now I'm going to go through just a few myths out there. A trend is your friend, but until it ends. This is an example of silver having a beautiful trend to the upside. Keep in mind that trend ended violently. It corrected 30% in 1 week. And I've spoken to many kind of big some highly liquid clients that had a lot of money in silver, and it was that lack of exit strategy in silver which unfortunately led them to lose a lot of money on the downside. Just keep in mind, even if that trend looks beautiful and it is being very friendly, it can really turn into an enemy very quickly. And so it's very important to know when that trend is likely to end. A lot of my analysis focuses on this because I specialize on market timing. And the key ways that I do that is by looking at market cycles, which tell you where the trends are, but they also tell you where the turning points are. And keep in mind, I look at candlestick patterns and even more than that, indicators such as the market indicators, which help me look for the counter trade. Key levels and false breakouts. Watch out for those bull and bear traps. I'll focus more about this. Key levels, remember that second part of the pyramid I was showing you? Key levels, Eurodollar has been a fantastic example of how key levels haven't worked. Here you can see 145 on Eurodollar. Continuously you had false breakouts above 145, and many times you had to wait for the market to hold above that level or to prove that it was going to break out from that level before you traded it. And 140 was another level. How many times did we have failed breakouts beneath or above 140 on Eurodollar? At least 2-3 times. And more recently, when we had that October 31st intervention from Japan, we had a massive move to the upside, which broke above the 200-moving average. A lot of long positions triggered, and then a lot of long positions wiped out of the market. So key levels, we need to be aware of false breakouts and bull and bear traps. And keep in mind that when we see these bull and bear traps, they are actually some of the best trade setups during these volatile markets. You can make money in these markets. You just need to adapt the trade strategy that you're using, and I'll expand more about that in the next webinar. Exit strategies is my last slide. As the last presenter mentioned very wisely, control your risk. There are different ways of looking at stop levels. I'm asked this question many times, and I'm just going to quickly go over it. You can use technical stops. Beware of round numbers. A lot of market makers, a lot of other people in the market, like you and I, are looking at round numbers. So maybe not the best numbers to choose if everyone else is choosing the same number or looking to squeeze people out at that level. Financial stops, you might base a stop based on your money management. That's important, but it depends how you set that up in terms of percentage of your capital and how many times you want to trade, a month or a year. Volatility-based stops are my favorite because this really just focuses on price behavior. How volatile is the market? And based on the volatility signal of the market, then you can really kind of choose an appropriate stop level. It's unwise to choose a 10-point stop on a market that trades 1,000 points in one day. Keep that in mind. Break-even stops, when you're in the money on a position, long or short, it's really important to make sure you realize that profit. So a lot of the times within the trades that we actually add on our moves, we take the stop onto our entry level, so we make sure that it's a risk-free trade, and then the moment we start to make profit target 1, profit target 2 or 3, we then move the stop even further, and we trail that stop to make sure we lock in some profit and, of course, minimize the risk. So I'll talk more about that in the next webinar. So the next webinar is Successful Trading in the Volatile Year of 2012, 23rd of January, 4 o'clock. Please try and sign up in advance. My email address is r.william@migbank.com. MIG Bank are available on social media website, Facebook. I'm available on Twitter and LinkedIn. Twitter is rwilliam77, and LinkedIn is just my first and last name, and just forexstreet.net for further blogs. The question that's just asked here on average to range, yes, I do use average to range. I'm a big fan of average to range, and I'll talk more about that in the next webinar. We probably just have 1 or 2 moments for questions, and any questions on some of the stuff that I covered. If not, maybe send me an email. I'm very good with answering questions at the end. Okay, so my email address is here, r.william@migbank.com. Please feel free to email me after the webinar, and I can get you back a reply. My mantra in each of my webinars is enlightenment to realize knowledge. We learn from each other. And I look forward to the webinars into next year. If you send me an email with, I can answer any questions that you may have, or send you any charts that you might find interesting. I'm happy to share that information. And of course, I can send you those research reports I mentioned on gold and Japanese yen. I can send that to you very easily. And of course, you can also receive our daily reports for a certain amount of time. So I'm going to end off on that to give the FX Street team enough time to set up for the next webinar, which I hope you can also attend. Big thanks from me. And yes, thank you very much, Roki. I did make it. This is a very kind of good point that we're finishing in time. And I do want to wish everyone a happy holiday season and a happy new year. It's been an honor and a pleasure, as always, hosting these webinars for MIG Banking Session with FX Street. Thank you, everyone, for your kind support. I've received lots of really beautiful feedback, and I really appreciate it. Please feel free to send me any questions that you have. And I wish you a fantastic 2012 and, of course, a profitable one as well. And we'll talk more about how we can maybe achieve that goal in the webinar on January 23rd. Thank you very much. All the best to you and your families. Ron William, Technical Strategist here at MIG Bank Switzerland.